As we approach year end, our wealth management team is focused on opportunities for strategic tax and philanthropic planning. Strategic tax planning involves taking a multi-year view of expected marginal brackets, focusing on deductions in high tax rate years, and shifting income to years where we expect to be in lower brackets. Income shifting is achievable through strategies such as accelerating or limiting the realization of capital gains, Roth IRA conversions, or increased pre-tax retirement savings. The combination of low interest rates as we started the year and the declining stock market in 2022 has resulted in lower than average income and capital gains realization for many. If this applies to you, your tax advisors may wish to review some smart strategies for shifting income from future years into the lower bracket that might apply for this year. Roth IRA conversions continue to be front and center in many of these discussions since the tax cost of conversions is lower when market values are lower. With the 2017 Tax Cuts and Jobs Act eliminating many itemized deductions and limiting the state and local or SALT deductions to $10,000 per year, it's become more difficult to manage personal income taxes by grouping deductions. However, for those so inclined, charitable giving allows for a very positive impact to others and remains ripe for strategic tax planning. Interestingly, charitable giving is subject to both minimums and maximums when it comes to getting the tax benefit. At a high level, if your total income tax deductions do not exceed the standard deduction based on your filing status, you may not realize a tax benefit for your giving. In this way, the standard deduction, less your other itemized deductions, becomes that minimum for achieving a tax benefit. Let's look at an example. The standard deduction for married filing jointly in 2022 is $25,900. If you're paying more than $10,000 in state and local taxes, then you can claim that maximum $10,000 SALT deduction. Assuming no other deductions, you would then need to exceed $15,900 in charitable giving for the year before you receive an extra tax benefit for that gift. On the flip side, there's also a maximum amount of tax deduction that can be claimed on one's tax return. When giving to public charities, we can generally deduct up to 30% of our adjusted gross income through the contribution of appreciated assets, such as stocks that have long-term capital gains. If we want to exceed this amount, we can top off the gifts with cash up to a total of 60% or carry those deductions forward for a number of years. Let's look at an example. If our total adjusted gross income, or AGI, is $100,000, we could gift up to $30,000 in appreciated assets and then an additional $30,000 in cash. As you consider your different options, don't forget that giving appreciated assets to charity has the added benefit of avoiding capital gains that might otherwise be incurred if the asset was sold. Well, before we wrap up, the calendar year also marks the beginning, or more pertinent, the end of other opportunities such as family gifting, 529 education savings, and retirement plan funding. The current annual exclusion for individual gifting is $16,000 per recipient, and the maximum 401k funding is $20,500, with an additional $6,500 for those age 50 or older. There are many different deadlines, and we encourage you to consider any year-end deadlines that might apply to your planning and take action before the end of the year. We cover more details on several of these topics in our quarterly Wealth Management Insights newsletter and other videos. Don't hesitate to reach out to your Ferguson-Wellman and West Bering team for a nudge in the right direction or a more personal planning review. We wish you happiness each day as you make the most of the remainder of 2022.